your workers ahead of time. A lot of time companies pay the salary for January 1st, a few days before Christmas, okay? As a favor. But technically speaking, those guys are getting paid for the month of January. So they haven't earned that yet. Since I pay them early, that's an asset for me. Because later on, I'm not gonna pay something I would have paid. Of course, as soon as I paid, I take that down. In terms of what you want to call fixed assets, obviously the biggest categories, property and equipment, and the buildings, machinery, that sort of stuff. This is kind of important. Sometimes companies don't buy assets, they actually lease them. But leases are grouped into two assets. A lease is basically a rent, right? Suppose you need a forklift for your operations. You can buy the forklift outright, then it would be listed under equipment, or you could lease it. Lease is rented, so you actually make payments. But if essentially present value of all the lease payments that you're making is about, I do believe, 90% of the actual value, that's considered a capital lease. And you have to list it as equipment. But we're not going to worry about it too much. These are typically what we call tangible assets. A tangible asset is something that has a physical existence. Okay? I can touch it, I can see it. I can see a forklift, I can see a building. Or I can see a stock. Even though stocks are virtual these days, it's not like they have the stock certificates. By the way, if you do want them, you have to ask the company to issue it for you. They do it. Some people do it for decorating purposes. There are also assets that are called intangible assets. These are assets that do not have a physical existence. Copyrights are among them. If you bought the copyrights to a movie, that is an intangible asset. It has value if you just bought it. But there is an intangible asset a lot of guys may not have heard about, but especially for companies that do acquisitions, it can be a big number. It's called goodwill. Anybody knows or can guess what that could be? Again, it's okay if you don't. It's somewhat esoteric, but it's a big number, as you can see. They have more goodwill than they have cash, if you look at it. Not just cash, not marketing securities. Whenever a company makes an acquisition, there's a difference between the value they pay for it and the so-called book value. I'll give you two famous examples. One is Google bought YouTube back in 2004, I believe, for $1.6 billion. I mean, was that a good purchase? At that point, if you looked at YouTube's books, their net worth or total equity was half a billion dollars. So the difference, and accountants like double entry bookkeeping, if I'm spending $1.6 billion and I'm listing that as an asset because I spent $1.6 billion, or I'm gonna deduct it from my expenses, where did I spend it? Now, on the books, because I bought all the assets of YouTube and liabilities, right? And that's worth $500 million. The other 1.1 is the goodwill. It's the excess of purchase price over and above the book value of the asset you acquire. If it is below, you don't book on goodwill. Until about 2006, I believe, you actually didn't have to, you actually had to amortize the goodwill over 40 years. So if you had $1 billion worth of goodwill on an acquisition, every year you were supposed to write off $25 million as amortization of goodwill. After 2006, you don't have to do that anymore, but you have to do a test for impairment in value. Example, who remembers MySpace here? Okay, that was Facebook before Facebook. And Wall Street Journal, this is owned by Fox Business Group, purchased MySpace, I don't remember exactly, 2007, something like that. And that for about $500 million.
Big thing.
Oh yeah. At that point, Zuckerberg had still exists. I mean, it was that early. I'm assuming he still exists. Who knows what MySpace does these days? I mean, you could find most of the pedophile on MySpace these days. It's basically good for nothing. It's like the dark web of social media, right? So let's think about, and at that point, MySpace did not even have any revenues, okay? It was that new. Those days, people valued companies based on number of hits or number of subscribers they had. But Wall Street Journal rightfully decided that the social media is going to be a good thing. They didn't realize that, Facebook was going to be better. Anyway, they paid $500 million for it. As of probably 2010, MySpace was essentially worth nothing. So it's a good accounting practice to test impairment. And you say, if I were to sell this asset now, what would I have gotten for? The answer is zero. That entire goodwill has to be written off. Okay? That's the only rule with goodwill. So even if you don't make any acquisitions on a year, because you test for impairment, goodwill may change over time. You may have things like deferred income taxes. Technically, that's a tangible asset. At least I'd like to think it is a taxable asset. These are things the rules for which you assign tax in a GAAP financial statement and the actual taxes you pay according to IRS rules are not the same. Okay? So when I look at the income statement, for example, for Apple, I'm going to see a tax number over there, this much income tax. But we pretty much know that Apple does not pay any federal income taxes because they do something called transfer pricing. It is a fancy name in accounting for arbitrage in different tax jurisdictions to minimize tax burden. For example, Ireland has, I think, 12% corporate tax rate. So most of the Apple's revenues are booked in Ireland. They actually pay corporate income tax over there. But, the company is a U.S. company. And the U.S. tax code says, unless that income is actually repatriated here, we don't view that as taxable income. So technically speaking, they charge a lot more than they pay. They write off as tax a lot more than they pay. That is the deferred tax income asset. Because you said in your income statement, I paid $20 billion. But you know that you paid only 10. Okay? But until that is resolved, that $10 million is an asset. Because you wrote it off as expense. Remember, in financial statements, in double entry bookkeeping, things have to balance. if I write something as an expense, $20 billion, that reduces what I'm going to get for retained earnings, okay? And that's going to reduce the equity. If it's reducing the equity, to balance things, I have to do something, right? So you actually book an asset so that they cancel each other out. Remember, balance sheet identity. Assets plus liabilities have to equal, assets should equal liabilities plus equity. Of course, you always have the other asset stuff. For real detailed financial analysis, obviously you need more details. You can get a lot of those from notes to financial statements. But if you're not an equity analyst, this is just good enough. It just gives you an overall number. And in terms of shareholders' equity, certain companies have what we call preferred stock. Technically speaking, for IRS purposes, preferred stock is stock. If you have preferred stocks are obligated to pay certain amount of dividend. Okay? Technically, it's interest. The preferred stock is a debt instrument that never expires. You just pay interest on it every period. It's like a perpetuity.